Let's get you up to speed on a very interesting story. A big day for the oil market. Check out WTI and Brent both down more than 2.5% down. Really surprising. Why? Because as of today, the long-awaited EU-Russian oil embargo is official. It was accompanied by a new price cap on Russian crude set by G7 countries. That, of course, designed to limit Russia's revenues while allowing countries such as China and India to continue to buy Russian oil, provided they don't pay more than the $60 per barrel cap. Joining us now for more on the markets, Brad McMillan, Commonwealth Financial Network CIO. Good to see you, sir. Going to dive into an interesting day in the equity markets. But first, let's just start with your broad reaction to that move in oil down on all that news. We expected the opposite reaction.
I think what we're seeing here is the market pricing in what increasingly looks like a recession. You know, we've got issues in China, we've got issues in the U.S. The Fed is not going to back off. When you look at the jobs report, when you look at the services number, I mean, the market is saying over and over, we are going to see a slowdown, and that's going to pull back on everything, especially oil. I don't think the recession is going to be that bad, but that's what the market is seeing right now.
Brad, you don't think the recession is going to be that bad? I guess, what degree do you see the recession more accurately? And then what does that mean for investors at this point? Because certainly just judging by the broader market reaction today, many investors remain pretty concerned.
I think it's right to be concerned, but at the same time, you have to look at what the economy actually is. And mostly it's people working and spending and saving. And so that's over 70% of the economy. And when you look at the bottom line of companies, that's pretty much what they're watching. So as long as the job market stays healthy, and remember, job growth has been at or above the levels we typically see in a boom. We're still in boom levels of job growth. And when we see wage growth being strong, which we do, and then when you look at businesses continuing to invest because they can't hire and because they've got to meet those demand needs, when you put all of that together, the Fed's going to have to do a lot to throttle that kind of energy. And I have no doubt they're going to try, but it's going to take a while, and we're going to see growth until then.
But saying the recession isn't going to be that bad, of course, implies we are, in fact, going to have a recession. Can the consumer spend our way out of it, Brad?
Well, the thing is, if the consumers keep spending the way they have been, we won't get a recession. You know, why are we going to get a recession? Well, it'll probably be an investment-led recession if indeed we do get one. Where's that going to come from? That's going to come from housing. That's going to come from probably fixed investments. In other words, there's going to be a lot of things, but it's not going to come from the majority of the economy. And as long as the consumer remains strong, if we do see a recession, then it's going to be a mild one. And that's what I'm talking about. Unless the consumer really rolls over, the damage we're going to see is going to be limited. And that's going to mitigate anything we see from the market's point of view. I think the market's getting too upset right now.
So, Brad, taking all that into account, the data that we got out this morning, the jobs report that we got out last week, in terms of what the Fed is likely going to do, the Wall Street Journal report saying 50 basis points could be on the table for the next two meetings. Is there any risk that the Fed might be too aggressive then at this point?
I think the Fed is going to back off a little bit because they've already done a tremendous amount in terms of raising rates. And right now they're starting to get to the point where the lag in that, they're looking to see a slowdown, but it's probably not going to hit until the middle towards the end of next year. And so right now they're going to back off a little bit, but they're going to still keep going. 50 basis points this meeting, 50 basis points the one after that. And then we're going to see. But if we see job growth, if we see wage growth, I see them staying at 50 and just keeping going because that's what they're going to have to do.
It sure would be interesting if they have been overly aggressive. We would see it, of course, first in the housing market. I know you've been watching that. What are you seeing? Do you see signs of an imminent crash or just a leveling out?
Well, the real question, when you say a crash, everybody's thinking of 2008.
Yeah.
And we're not going to see a 2008. And the reason for that is demand. When you look at the demographics, when you look at the ability of people to spend, when you look at the sheer number of households that are looking to find a place to live, we don't have the excess supply that we did in 2008. So because of that, we're going to see prices moderate. We're going to see prices go down. They're already down significantly in many markets. They might go down a bit further, but we're not going to see a crash. And when the Fed does start to back off, and remember, we're seeing inflation starting to roll over, so the Fed might not have to push that much harder, even if the economy grows. then I think you're going to see the housing market recover faster than people think.
Brad, let's talk about overseas because a number of Chinese U.S. listed stocks on the move this afternoon. Morgan Stanley was out with the note saying that China factors are improving. They referenced the potential for COVID rules to be relaxing, also saying that property market there seems to be stabilizing. Are you seeing any investment opportunity there just yet?
I think in the short term, we are going to see some continued positive movement. I think the Chinese government is adjusting their policy. I don't think they're backing off, but they're coming up with a way to work with the people to keep the economy going. And I think part of the reason that's happening is they're starting to see the damage really start to mount. I mean, in that respect, one of the biggest concerns I would have is the public decision, and that's important that it's public, by Apple to start moving production out of China. Apple's a bellwether company. They've hung tough even through everything over there. If they're actually starting to talk about moving out, then I think China is going to have to figure out a way to do a better job with the COVID restrictions. That's only going to be positive in the short term.